uh, calculated compound interest in some class. That's universal, right? You did it in what, 5th, 6th grade? Something like that, 7th grade? 4th? Yeah, anyway. Where you just, compound, exponential, right? Growth, compound interest. Anyway, how long have you been doing exponentials? I have a long time. Anyway, and then the reverse of that is instead of adding interest, subtracting the interest out, which is calculating present values. How many of you have done present values in some environment someplace? You're not going to admit it. You never took the interest out. You're not going to get $1 cash, $100, say. A year from now, what's it worth now? At different interest rates, take the interest out. Now I see some heads shaking, yes, yeah. Anyway, you probably did it in a math class, and you know how math classes are, they don't have any context for reality whatsoever, right? And you learn this stuff and you think I'm never going to use it. For those of you who aren't going to be accountants or finance types, you think this class is that way too, right? But it's not really true. You're going to use this stuff, right? You really are. It's stuff you're going to want to know, and trust me, you want to know this one. Every single asset, and therefore every liability and every equity, is valued this way. This is nothing against you or anything, but please don't let this happen after I use this example. If he gets run over by a truck when he leaves class today, and he's smashed and he's dead, what are his parents going to sue for? Not him. What are they going to sue for? Seeing as you're sitting in his class and you're brilliant, right? And I'll even vouch for that, what the hell I ran over you. Anyway, so he's brilliant, he's doing really well. You gonna count him, maybe?
No, not yet.
Oh, too bad, they'd get more money. All right. Anyway, they're going to predict, his attorneys are going to predict how much he's going to make for the rest of his life. Of course, he's going to be a billionaire, right? And you know what the other attorneys are going to do? They're going to say you're a drug addict and you're never going to make any money as long as you live, right? They'll try to prove that. So, and what's the deal? It's what you're going to earn for the rest of your life is what you're worth. Discounted back to now at the appropriate discount rate. And I suggest there's absolutely no risk, so it should be zero interest rate, right? And what would the other side predict? Oh, there's a very slim chance he's ever going to earn anything, so it's an extremely high discount rate, right? No kidding. That's how we value lives when people lose them. How do you think we value a building? Same thing. How does UPS value an airplane when they're going to buy it? Same thing. How does Boeing value the airplane? Same thing. That's how they figure out the price that they're going to negotiate at. How much is UPS going to give cash in and cash out over the life of that airplane? Discounted by the risk level, appropriate risk level, discount rate. Back to now is how much they're going to offer. That's it. And Boeing tries to guess how much they're willing to pay. Now you would think, it's like, how much do you have to pay for a car? Right? If you went to a car lot, the two of you, right, and you're buying exactly the same car, with exactly the same options on it, exactly the same sticker, you got the idea? Exactly the same list price. You're a horrible negotiator. You pay the full list price. So it's a $30,000 car. He pays $30,000, right? You go in and you talk him into 24. How much was his car worth? 30. How much was his car worth? 24. No, not 30. 24. He didn't make a gain. He just bought it. I said it was worth 24. It was worth 24 to him. It was worth 30 to him. Exactly the same thing. Now, if they were to try to resell it, now you'd have trouble valuing it, wouldn't you? Okay. So what companies do is they look at the future cash flows. Companies don't want to own assets. They want your cash, right? Walmart does not want to have any stores. They want your cash. They don't want inventory. They want your cash. They don't want equipment. They want your cash. They don't want employees either. This is how we value employees. How much are you going to pay an employee? How much cash are they going to generate in the future? Discounted back to now. That's it. That's what I'm willing to give them. Theoretically, that's how they're valuing baseball players. So, actually, not theoretically, they really are. But you're trying to guess how much they're going to generate, right? Okay? So we'll talk about this stuff a lot. That's the next chapter. I want you to read it. I want you to take it really seriously because you are going to know how to do future values and present values. Future values is adding the interest, present values is taking it out, right? You figure out how things are worth, what they're worth now or what they're going to be worth in the future, right? That's it. That's what we do for everything. Everything's valued that way, okay? So when you're making investments, that's what you do, value the stock, right? Either that or you can just take whatever the market offers. You know, that 30,000 sticker, you can just pay it, right? If you don't have any idea what it's really worth. Yeah, that's dangerous, right? People who know what they're doing will take all your wealth. Actually, you'll never accumulate it. That'll be fine. Okay, because everything keeps taking it all along. So you want to know how to do this. Okay, anyway, let's do the depreciation stuff, though. That's what this chapter is about. So let's say we bought a piece of equipment. Let's do an example on this, okay? And we'll do a couple different methods of depreciation. Okay, so here we go. Let's say I buy a truck, because I really like trucks. I've never really had a truck. I had a Jeep Cherokee once. That's the closest I got. Now my wife wants to buy a motorhome. Except like everything, we can't really buy one because she only wants the most expensive one on earth. Well, close. It's got to be Airstream thing, you know. So anyway, so that's probably good because then we don't buy one at all. Save the money, right? Don't you think? Yeah. So anyway, all right. So let's say we buy a truck, okay? And we put it in an account called Cleverly Trucks. You like that? Okay. So let's buy the truck for, I don't know, $120,000, right? And let's assign to that. So what would you do? Debit trucks for 120, credit cash, they paid cash. What if you made a 10% down payment? Debit trucks for 120, credit cash for what?
12,000.
12,000. Credit what else? Don't tell me accounts payable. Nobody's going to trust you to pay them on open account. Notes payable, right? You sign a note, have interest on it probably, right? Notes payable for, what would that be? 108? Everybody got the idea? You know how to do this, don't you? I don't need to write it down anymore. Isn't that cool when you go to work? People won't have to write it down. You don't know what's going on. That's a value, right? And people don't want to reteach you virtually everything you learned in your college career when you go to work. They expect to, by the way. But if you know how to do it already and they start explaining it, say, well, yeah, that's this and this and this and this. Oh, man, they want you on their jobs, right? They want you to work on the projects. You already know, right? And then they can add to what you know, and they'll pick up right at the end of your knowledge base and start building more for you. Well, build for them, right? You get more done, but then you're more valuable, right? Whether you stay there or go someplace else. So keep doing it, you guys. It's paying off. Okay, what's a salvage value or residual value? What I think I'm going to do what? Sell it for at the end. It's the salvage value when you sell it, right? Or the residual value, what's left over. That's all it is. Okay, let's say it's 20,000 because Keith wants his math to be easy. Okay? So what's the depreciable value, the amount you're going to depreciate, guys? 100,000. This is a snap, right? Let's give it a 5-year life, okay? So I hereby decree the life is 5 years. Okay? And for now, let's say we bought it right at the beginning of the year. We could buy it mid-year. It's not a big deal. We'll handle that later. Okay? It's not a big deal. If you buy it in the middle of the year, you take a half-year depreciation, right? First year. And then you'll have to add a year at the other end and take the other half year. Make sense? No matter which method you're using, you can do that. So you still get 5 years total. Half a year the first year, then 4 full years, right? Then half a year the next year, so it spreads over 6 years, then half a year. Okay? The author shows you that. So let's do this. Let's try a straight line. And let's do the journal entries too. Oh, by the way, what you're doing is you're coming up with the journal entry. What's the journal entry going to be? I'm using up this asset. As I use it up, what do? I debit what, everybody? Reflecting using up its utility value. Not its market value. I don't know what's happened to the market value. And you know what? I don't care. I have a Miata up over there. Hey, you ought to take a look at it because I washed it. I only do that about once a year. It really looks nice when I wash it. The paint job's still pretty good after 15 years. And pretty good after 15 years. It's got about getting close to 80,000 miles. Okay? It's sitting over there. Do I care how much that Miata's worth? I'm going to drive it probably until I die. It's a really well-made car. I probably will. Do I care how much it's worth? Not particularly. It doesn't matter. When will I get rid of it if I get rid of it? When it ceases to run. Right? When it stops. It runs like it was new. It's unbelievable. A really well-made car. I'm not saying all Mazdas are well-made cars, but Miatas are unbelievable. But $30,000 for 2 seats, little tiny thing, it ought to be well-made. Right? Okay? Although it's in the shop right now, it's making a funny noise, and I might have a wheel bearing going out. And then I had the windows. One of them quit working too. In 15 years, that's what's gone wrong with the car. Oil changes, lots of tires. Might be something to do with how the driver drives it. You know, those low radial tires that roll over when you go around corners and really grip the road and make it about 30,000 miles. Yeah, anyway. So, I had to put nice tires on the lot. Too bad. Okay, anyway, good car. So, do I care what it's worth? No. So what I do if I was depreciating over its life is depreciate what? Using up its utility value. What do I mean by that? Usefulness to me. Not a 747 anymore. A jet aircraft, whatever they're buying now, Airbus or something, right? Or whatever the Boeing one is, right? At UPS, they don't care what the market value is. Are they ever going to sell it? Not until it's fully used up. I mean, they're really going to use it up. And they'll still sell it, right? We'll talk about that later. So they ultimately will care, but that's not the big thing. What do they really care about? How long it's going to last and how many air miles they're going to get out of it. Make sense? Okay, that's what matters. Okay, so anyway, so let's do straight line here over 5 years, assuming they're all full years. Let's come up with a journal entry. You guys said the journal entry is what? Debit what? In every case, it's going to be debit what? We're using it up.
Depreciation expense.
Depreciation, because that's what we're doing, is depreciating it. And expense, because it's a cost that we incur to get our revenues. Right, guys? I have a truck. I'm using it to deliver product, right? Whatever it is. Whatever you use the truck for. Okay, so I'm going to have that debit. And then I'm going to have a credit to what, of course? I don't credit the truck because the truck's not really going away. It's still there, right?
Accumulation.
Accumulated depreciation. You got it. So we're estimating how much of the truck we have used up each year. That's what's in depreciation expense. And the full amount that we've accumulated over time, that we've used up, is in accumulated depreciation. What kind of account is accumulated depreciation? Contra asset. Do you close that? Of course not. Right? It's an asset. You know you don't close it. So we're going to constantly show the equipment less the accumulated depreciation on the balance sheet. Year after year after year after year, and accumulated depreciation is going to grow, isn't it? Right? Depreciation expense, what are you going to do with that?
Zero.
Close it to retained earnings, right? Zero it out, close it to retained earnings. Over and over and over and over, right? We're going to reduce our income by the amount of depreciation every time. Big deal, okay? So let's figure out what it is. So we've got what? Year 1, 2, 3, 4, 5. What do I want to do in terms of depreciating it? I want to depreciate what? The 120,000 or the 100? What do you want to have left as remaining book value at the end if the residual value is 20? Come on, what do you think it should be?
100.
Well, you're going to depreciate 100 so that you have a remaining book value of 20. Got it. That's it. So for most of the methods, all but one, all but declining balance, we are going to depreciate the depreciable value because I want to leave that salvage value. Got it? If I'm using declining balance, I'm always taking a percent of what's left. So I can't use the 100. I'd have to use the 120. But I'll still stop when I get down to the salvage value of 20. Okay? All right? So that's the only difference in these different methods. All right, anyway, so it's straight line, you guys. How much depreciation expense is there going to be every time? So let's do depreciation expense. And then let's do accumulated depreciation. And then let's do book value, remaining book value. So what I've got is depreciation expense, accumulated depreciation, book value for the 5 years, huh? And what do you want the expense to add up to over the whole 5 years? What do you think it's going to be?
100.
100,000. What do you want the book value to be at the end of the 5 years? 20. Make sense? What's the equipment going to be carried on the balance sheet at the whole time? 120. Got it, guys. That's it. Okay, so let's go. What's 1/5 of 100,000?
20.
What do you think every year's depreciation expense is going to be? 20. Every single one of them. If you do 5 years at 20, it's all going to total 100, isn't it? So the first year, it's going to be debit depreciation expense for how much? 20,000. You got to get these points up. Credit accumulated depreciation, what? 20,000. But you also know what's going on. You know what depreciation is. You know what you're looking at when you look at a balance sheet. Pretty cool, huh? Okay. When you're sitting in business meetings, you'll like it. Trust me. Okay. So what's the balance at the end of the first year? If I did this one time, what would be the balance in accumulated depreciation?
20.
So imagine you've got depreciation expense. Not imagine, you really would have, I guess. And you got accumulated depreciation. So the first year we put 20 into depreciation expense, don't we? That's that one. And we put 20 into accumulated depreciation, don't we? Debit and credit. Okay? So accumulated depreciation would be 20,000 at the end of the first year. What's the remaining book value? Be careful. It's not 100 less 20. What's in equipment on the balance sheet? In the equipment account, what's in the balance sheet? 120. So I'd show on my balance sheet 120 of equipment less accumulated depreciation of what? 20. What's book value?
100.
100,000. Big deal. Got it? Everybody on board? Then what do? You close depreciation expense, don't you, to retained earnings. It's part of the closing entry, isn't it? That gets closed and goes to zero. Everybody agree? You're going to start the next year. Accumulated depreciation stays there because it's a permanent or real account, right? Balance sheet account. Doesn't go away. The asset's not going away because you start a new year. Really, the expense isn't going away either. You're just putting it in retained earnings so you count a new year, right? Okay, here we go. Do exactly the same journal entry the second year. What do you got? Whoops. How much do you have for accumulated depreciation? Where do you go? 40. All right. Got it? What would be in depreciation expense, of course? Because you put 20 more in here, it makes it 40. You already see that? Put 20 in there, it makes it 20, right? So what happens? What's your remaining book value?
80.
It's 120 less 40, 80. And we just keep going, right? Just keep going. Close it again and go again. What are we going to have by the end in accumulated depreciation, of course? 100. How much depreciation expense will we have? Well, of course, 100. It's just 20 a year, right? Okay, and where do we end up in terms of book value by the end? It goes down from 80 to 60 to 40 to what? 20, and we're done. Everybody see it? Now, these journal entries are going to be the same, right? It's debit depreciation expense, credit accumulated depreciation. You wouldn't believe how many people on this quiz did debit allowance for doubtful accounts and credit bad debt expense. Or debit sales and credit bad debt expense. Or debit sales and credit allowance for doubtful accounts. All kinds of crazy stuff. How do you replenish a bad debt account? How do you replenish the allowance? You increase it with a what? Credit. You credit allowance for doubtful accounts. So what do you always debit, of course? What are you doing? You're calculating what bad debt expense is. So it's always debit bad debt expense and credit allowance, isn't it? Everybody should at least get the journal entry right, that 8-point problem. At least the debits and credits should be right. The amount might get screwed up. Right? There are a few errors on there too. But we'll get that down before the test, okay? Remember, the quizzes are to get you started. Right? I know you're trying to do homework, you're trying to do the old quizzes, but under real time, it's sort of like, you know, you practice and you get in a real game with a sport. What happens to the real game? At first, not much, right? Okay, so it's just to get you going, get you serious, real time. Then you need to get ready for the test, and you can nail it on the test if you take that approach, right? Okay, anyway, it works. You guys are going to get there. I'm feeling pretty good about it. You guys this semester, both of these classes this semester. Okay, just keep working, keep working. All right, let's do the next one then. So that's all straight line, huh? What if we were instead going to use one of the units of production they give you? Right? And this could be on anything, right? We could use units of production, or we could use miles, or we could use hours. Forklifts, we don't measure how many miles they go, we use hours, right? Because what wears out a forklift is going up and down, lifting loads, not the miles that it drives. Miles mean nothing, right? They aren't really miles. But there's lots of lifting up and down, and that's where you wear out a forklift. Okay? On an automobile, it's really not years, it's really miles typically, right? On a truck like this, it might be how many miles you think you're going to use the truck. Really. Because, you know, if you use it 100,000 miles a year, that's different than if you use it 40,000 miles a year, right? How fast is it going to get used up? That's it, right? So, anyway, so let's say that we think we're going to drive this thing for 200,000 miles in our 5 years. That's not very much. But anyway, it's local deliveries, I guess. You know, you never go out of town. Okay? Just run around your neighborhood. Okay, so it's 40,000 miles, okay, per year. And if you drove the same amount every year. Okay? Got the idea? So we'll say it's 200,000 miles. So you tell me, how do I want to do my depreciation? I'm going to come up with the same entry, debit depreciation, expense credit, accumulated depreciation. It's just going to be a different number, right? Okay, so how would I do it? If I have, with units of production, if I estimate I'm going to go 200,000 miles, or if it's a piece of equipment, a manufacturing piece of equipment, it could be 2,000 units of finished product it produces, right? Whatever it is, okay? Or hours on a forklift or something. So I say the life of this thing, instead of the life being 5 years, the life is 200,000 miles. How much do you want to depreciate per mile? It's not per year anymore, it's per mile. Got it? So it's 200,000 miles. What are you going to depreciate? How much? I want to depreciate until I'm down to what? 20,000. So how much do I have to depreciate? 100,000, right? I bought this thing for 120, right? I wanted to have a salvage value of 20 at the end. Got the idea? And so I'm going to have to depreciate the 100 again, aren't I? Okay, so just, what do? You take the 100,000 cost, depreciable value, not the cost, depreciable value, and divide it by whatever your units is. In this case, it's 200,000 miles. You like it? So every mile I drive, how much depreciation am I going to have? 100,000 divided by 200,000, what do you get? 50 cents. It's 50 cents per mile for depreciation. How about if I do 10,000 miles in a year? 10,000 times 50 cents. $5,000, right? For 10,000 miles. How about if I do 100,000 miles in a year? 50 cents times 100, what is it? 50,000. Got it? Everybody good? So let's say that I have this. Let's do years again. So now we're doing units of production. Let's say what I've got is in year 1, year 2, 3, got the idea? 4, 5. Okay, here's my miles. Now, by the way, this is an estimate of the miles, right? This is actual miles. Make sense? So after the fact, we find, you know how many miles you're going to drive your car before the year starts? Of course not. You know how many miles you drove it after the year's over? Of course you do. Right? Got it? You can figure it out. Okay, so this is an estimate, and then we're going to do the actual. Okay, so let's say the first year is 35,000. The second year is 45,000. Third year is 55,000. The fourth year is, man, I really jumped, 50,000. And the fifth year is 45,000. Okay, win something like that. Got it? Tell me how much depreciation I'd have each year. So that's the miles, and it's going to be 50 cents a mile for every mile, right? This is my actual. Okay, so give me the depreciation expense, and then give me the accumulated depreciation. Okay, and then give me the book value. What's left, right? Okay, of the asset. Okay, on my balance sheet. So it's still a $120,000 asset, and I'm depreciating it over these miles now. Okay? So what would it be the first one? What do you do? 35,000 times what?
45.
50 cents, yeah, times $0.5. Okay? What's that, 17.5? What's the journal entry, you guys? Debit what? Depreciation expense. Credit what? Accumulated depreciation, right? For only a 17.5. That's how much I used up with this method. What would be the balance in accumulated depreciation? Because we're going to add it up just like we did over here, right? 17.5. So what's the remaining book value? Be careful. What did we buy the asset for? 120. Don't use the 100. That's a common mistake. You understand why people would, right? That'll give you the remaining depreciable value. We went with the book value that's going to be on the balance sheet, right? I'm going to show a $120,000 asset on the balance sheet, 17.5 of accumulated depreciation on the balance sheet. What's the remaining asset? What is it? 102. Yeah, 17.5. 102.5. Everybody got it? We're all on the same page with this? Easy, isn't it? Okay. What would you do the next year? 45,000 this time, though, right? Times 50 cents. 45,000 miles times 50 cents is how much? 22.5. What's the journal entry, everybody? Debit what? Depreciation expense. Credit what? Accumulated depreciation. Even I could do this. You see why I'm in this profession. It pays really well. It's easy. It's nice, huh? Okay. Anyway, so what do we got? 40,000? Yeah, it is, isn't it? Wouldn't accumulated depreciation, if you put 17.5 in there, and then you add another 40, you go up to, put in 17.5 and add another 22.5. Wouldn't it go up to 40? Yeah, sure it would. Okay? All right, what's the remaining book value? 120 less 40 is what? Okay, now with this method, what do I have to be careful of? Make sure you don't go below what on remaining book value? 20. So if I used more than 200,000 miles, which I think I did here, if I use more than 200,000 miles, they're free after the 200,000th mile, right? In fact, if it's a 5-year life, what if I use it longer? It's free. You have nothing left to depreciate. You got the idea? Everybody good? Although we could change the salvage value if we want at the end. We can reduce it down and depreciate that much. Yes?
So when I'm writing the journal entry, if I want my debits equal my credits, so the depreciation expense is 22.5.
Yeah, for that second year there, 22.5.
Should I make the accumulated depreciation 40,000?
No, 22.5.
Okay.
Because remember, in accumulated depreciation, that's a great question. In accumulated depreciation, we are adding up what we put in there. So the first year we put in 17,500, right? The second year you put in 22.5. That makes the balance in accumulated depreciation. This is the balance in it, okay? not just a credit to it. It makes the balance 40,000. Did that clear that up? That's a great question. Yeah. Some of you guys got confused on your bad debt thing again, right? The provision. And you debited bad debt expense for the amount you wanted there, and you credited accumulated depreciation, or I'm sorry, you debited bad debt expense for the amount you wanted there, and you credit allowance for doubtful accounts for the amount you wanted there, and they weren't the same number. Can that ever be the case? Can debits ever not equal credits? No, you'll be out of balance, and your balance sheet will be out of balance, right? When you do one. So it's got to be the same. So remember that with that, what are we doing? We're making bad debt expense be what we want it to be, or making the allowance be what we want it to be. You don't get both, right? Compromise on it. Same thing here. We'll make depreciation expense be whatever it's going to be, and that forces the allowance to be the sort of, the increase in that is the same, right? Or vice versa. Okay, anyway, that's a great question. Thank you. What would this do then, the third year? Just keep going, right, guys? What is it? 27.5. And we want to be careful. Debit depreciation expense 27.5 this time. Credit accumulated depreciation 27.5. What does it give us for the accumulated depreciation now if you add another 27.5 to that? 67.5. Okay, and what do we have left now?
52.5.
52.5. And we can keep going until we get down to 20,000. Okay, the next year, fourth year, what would it be?
25.
25,000, right? Half of 50, okay? 50%, okay? 50 cents each. Okay, mile. All right, so debit depreciation expense 25, credit accumulated depreciation 25, correct? And what do we have?
92.
What's left?
27.5.
How much are we going to be able to depreciate the next year?
75.
7,500 is it, right? You got to stop there. What would half of 45,000 be? That would be 22.5. That one's not going to equal, right? All the other ones, it worked just fine. But when you get down to the salvage value, you have to stop. Got the idea? Or the residual value. So how much can we do? Only 7,500. That means it does not equal, you guys, right? It's not going to be 22.5. It's only going to be 7,500. Otherwise, we depreciate the whole thing, wouldn't we? So debit what for 7,500? Depreciation expense. Credit what? Accumulated depreciation, big deal. What do we have in the allowance for doubt? Or I'm sorry, in the allowance for doubt accounts. What do we have in the accumulated depreciation account?
100.
92.5 plus 7,500 is 100, and we are done depreciating this thing, aren't we? And how much will be the remaining book value? Which is exactly equal to what? Salvage value. We're good, huh? Got it? Okay. Then I've got another one that works kind of the same way. It's not in the book, but some companies use this. It's an old tax method. It's called sum of the year's digits. This is kind of a fun one. Going to give you some free points for being here.
Is that the same as double declining?
No. We'll do double declining balance or other declining balances after this one. This is one that's not in the book. Sum of the year's digits, not in the book. But I like to throw in something that's not in the book once in a while, right? Why not? Okay? There's lots of other things we could do in each of these chapters. So it's just something to make this a little more fun. Okay, something else to get. Sum of the year's digits. Okay, what we do here, this is a really weird one. This is an old tax method. It's not allowed for tax purposes anymore, but some companies still use it for financial statement purposes, right? What you do is you write down all of the year's digits, right, upside down. Okay? So how many years are there? I'll show you what we do here. We're going to do year 1, 2, 3, 4, 5. Just like we did those other two methods, right, guys? Okay? Sum of the year's digits. What we're going to do is we're going to write down in reverse order, okay, for each of these years. I'll write down 5, 4, 3, 2, 1. And obviously with a long life, this gets to be a little bit of a pain, but there's a little mathematical formula for doing it. Right? So it's not too bad. Okay? What do those add up to? Go ahead and add them up. 5 plus 4 plus 3 plus 2 plus 1. What do you get? What does that come up to? 15, doesn't it? Okay? So what we're going to do is we're going to depreciate 15/15ths of it over its life. So now it's going to be kind of like a straight line type thing, or kind of like the units of production. What I'm going to do is the first year I will cleverly take 5/15ths. So this is an accelerated method called sum of the year's digits. Straight line to straight line, accelerated is faster than that. Makes sense? Double declining balance, or 150% declining balance, or whatever you want to use, right? 175, 125. That's an accelerated method too. What these do for you is you have more depreciation in earlier years, right? But you'll have less in later years. When would you use something like straight line depreciation? When you think the asset gets used up the same amount every year. That makes sense? I think for a building, straight line depreciation probably makes sense. It probably gets used up about the same amount every year. How about for an automobile? No. In the early years you own an automobile, truck, something like that, a piece of equipment, what happens? There's no maintenance, right? It's real inexpensive to own it. So you're probably depreciating, you probably should be depreciating more in the early years. And then in the later years, what do you have if you keep it? More maintenance expense, right? So my wife's Volvo, we haven't made a payment on that Volvo in years. It's 10 years old. I just spent a couple hundred more on it. And a couple months ago, I spent $800 on it. And I keep telling my wife, well, you know, a new payment on that thing is like $500. As long as we're not spending $500 a month, who cares? Well, she does, because why? She wants a brand new car, right? She don't want to drive that old thing and spend money repairing it, right? So every time we repair it, she wants, it broke down this time again, you know, it's only been a couple months, and she says, let's just tow it to the Volvo dealer and get a new one. Don't do that, by the way, you guys. You get nothing for it, it doesn't run, right? There's something wrong with it. So at some point you have to decide to do that, I guess. I don't know. You could just wait until it quits running, couldn't you? Oh, there you go. I had that with a Honda. That worked out really good. During the gas shortages, too. It's really nice. Okay, so you get the idea here, what we're doing? Look at that. What we're going to do is we are going to depreciate. Those are fractions. We're going to depreciate 5/15ths in the first year, 4/15ths the second, 3/15ths, 2/15ths, 1/15. And when you add all those up, what will you have?
15 years.
15/15ths. Okay, so what I was saying is maybe for a building you use straight line. Maybe for equipment you might use, well, you could use units of production, couldn't you? How fast am I using it up? How many miles am I driving this thing, right? How many hours am I running the forklift? And this is a judgment call, right? There's lots of judgment calls in accounting. That's why it's a profession. It requires judgment. Otherwise, we just program the computer and forget about it, right? We wouldn't need people. Okay, really. And that's why it pays well. Okay, anyway, in the 5th year is 1/15. Got the idea? It'll be 15/15ths. So, what's the depreciation expense going to be each year? Let's do it. Let's do depreciation expense. And then, just like we did up here, right, on both methods, we're going to have all of them this way. Depreciation expense, accumulated depreciation. This is just called a depreciation schedule, by the way. It's no big deal. And then accumulated depreciation. And then, of course, accumulated depreciation away from the original cost gives us the book value of the thing, huh? But it's on the books app. What was your first year? 5/15ths is what, 1/3? 1/3 of what? How much do you want to depreciate, you guys? The depreciable value, what is it? How much?
I have a question. Why is accumulated depreciation twice?
Oh.
I was thinking.
Yeah, I was like, what?
That's sort of like lemmings to the sea, isn't it? Yeah. Okay. Depreciation expense, accumulated depreciation, and book value. Good for each key. Very good question. That would be confusing, wouldn't it? Okay, all right. Okay, here we go. So, what do you get the first year? Looks like a third. A third of, well, you know, 5/15ths. A third of what? Of the 100, because I want to stop at 20, right? So I want to depreciate over time the whole 100,000, don't you guys? And I want my accumulated depreciation at the end to be 100,000, and I want my book value at the end to be what? 20,000, which is that residual or salvage value, right, guys? Yeah. So how are we going to get there? I think what you could do is you could take 15 and divide it into 100,000. Way to screw up your example, Keith. Right? Okay, anyway, what is that? What's 1/15th of 100,000? Give me a real easy way to come up with this. What do you get?
$666.67.
Well, 6,667 about. Okay, is that good? Well, then that's 1/15th. That's why I put it on year 5. It's 1/15th. What's year 4? I guess it's double that, huh? 2/15ths. How much is that?
Twice that.
13,333. Yes, it is twice that. And then, could you take 3 times 6,667? Sounds like a decimal worship, right? Good thing we got the 7. Okay, anyway, 6,667 times 3, what do you get? It's a miracle. It's 20,000, isn't it? Well, of course, it's 1/5, 3/15, right? What's 4/15? Add 667 to it. 26, 667, right? And what's 5/15? Is that 33, 333? It's a third of 100,000. Everybody good? That's what they'd be, wouldn't it? And what's the first year's journal entry? Double what? For 33, 333, 1/3 of the 100,000. 5/15. What do you want to debit, everybody? Depreciation expense. What do you want to credit? Accumulated depreciation. This is ridiculously easy, isn't it? Okay, so you have 33, 333 here. Now you tell me, what's the book value?
120.
120 minus that. Not 100 minus it, 120 minus it, right? What does that give me?
86,667.
Yeah, we're going way beyond our math skills here. Anyway. You know, when I was first teaching, people could do this kind of thing in their head. Calculators were expensive, you didn't have very many of them around. And, you know, well, at least when I was in college, we did do it in our head. Or we could do it in our head. And we quit doing that stuff. So like you can't spell anymore. My spelling is just falling apart. It's rough using spell check, isn't it? Because when you read something, you have to actually know how to spell. To know the words that you spelled with, you know, there is spelled how many different ways. Right? 4 or 5 or something, right? Get the wrong one, look like an idiot, right? Yeah. Spell check thinks it's fine. Okay, what's the next one? We've depreciated 9/15 of it. What's it going to be? Is that 60,000? It is, isn't it? What's left? You know, it's 33, 333 plus 26, 667. What's left to go?
60.
What is it?
80. The 80 right
It's
there.
120
Minus 60.
minus 60 is 60. We're half. Is that right?
Yeah.
Yeah, we depreciated 60, right, of the 120. How much do we have left to depreciate? Only 40, because we're going to stop at 20, right? So can you see how you're depreciating this faster? You got higher expenses in the earlier years because you're using up the new asset maybe, right? Like a truck or something. That would make sense, wouldn't it? Okay, got the idea? Okay. And then what? It's going to be 80,000 because it's 20 that year. And what's left, everybody? 40. Okay. Then what's it going to be? Debit depreciation expense, credit accumulated depreciation. What do we have left?
Wouldn't that be 80?
Oh, yeah, I'm sorry. 80. I caught the 20 over, didn't I? Yeah, 60 plus 20 is 80. Thank you, whoever said that. Yeah, I'm trying to confuse you, not on purpose. Okay, yeah, so 20 added to 60 is 80. Now what do we have?
93.
93, 333. And what do we have left to go?
26, 67.
26, 667. How much more can we depreciate? Well, 6,667, huh? And guess what we'll do the last year? It's a miracle, huh? It's just math. Okay, so where are we at? 20,000 ending balance, right? We're in great shape. And that's not 6,667. I tried to do it again, didn't I? Yeah. That was okay. And we're there. Everybody got it? It is the 100, isn't it? Okay? We got it, don't we? Everybody see it? No big deal. So there's another method. I'll give you that just for some free points on the quiz test. I know, okay. So then what's left are the declining balance methods. Now here the world changes. Okay? It's the only, I'm doing it last because it's the only one that's different, okay? Those three, we are depreciating what, everybody? The depreciable value. Because we're depreciating 100% of the depreciable value with each one of those methods, right? Over 5 years, right? 1/5 a year. Oh, 1/15th, right? On the sum of the year's digits, right? So we do all 15/15ths of it. Everybody got the idea? Okay. And then units of production spread over the whole 200,000 miles in this case, right? Okay, so you have to use the depreciable value. On this one, what we're going to do is we are going to take a percent of the remaining balance. That's why it's called declining balance, because the balance is declining. In all these methods, does the balance decline over time? Of course it does, right? The balance declines over time. The balance declines over time. With this method, it will too. That's because you're depreciating it. Of course, the remaining balance declines. Okay, so here's what we're going to do. We are going to take the 120,000, okay? So what we're going to do is we are going to start with the original cost, all right? So let's start with the original cost, and let's make it double declining balance. What double declining balance is 200% declining balance. I bet you guys knew that 200, double and 200% mean the same thing. We could also do 150% declining balance. Guess what? That'd be 1.5 times instead of 2 times, right? Or 125% or 175. So if I give you something other than double, big deal, okay? If I give you 150%, you'll take 1.5 times. Well, then the question is times what? What this is, and listen to this one really carefully, it's like, yeah. It's double the percent straight line would have been. It's double the percent that straight line would be. So it's 150% declining balance is 150% of what straight line percentage would have been. Now listen to this too. It's double what the percentage would be, not double what straight line is. Because we're going to apply the percentage to the full cost. So this is going to be more than double what straight line would have been in the early years. And then of course, less in the later years. You guys see that with accelerated methods, you have less in the later years because you have more in the earlier years? In any case, we're only going to depreciate 100,000, right? You got the idea? You only depreciate the depreciable value. And with this method, we're going to stop when we get where? Because we want to have this salvage value at the end to be 20. When are we going to stop? When we get to 20. When the remaining book value is 20, I stop depreciating with any of these methods. Got the idea? It'll automatically happen with the other methods. Well, it didn't with units of reduction, did it? Right? You had to consciously keep track of it. Okay, and this one, you'll have to really keep track of it. Okay, so this time, we'll start with the book value over here at time 0, okay? At year 0, which is when I bought it. And then we'll do year 1, 2, 3, 4, 5, and we can calculate these. And what I want is I'm going to come up with what, everybody? My depreciation expense, right? My accumulated depreciation, just write it down once, Keith. I don't know if I've ever done that before. I come up with new ways to make mistakes all the time. It's amazing for all these years. And then book value, right? Okay? So we're going to do all those. But this time, I'm going to say, what's my beginning book value? Not my depreciable value. What's my beginning book value? If you have a $120,000 asset and you have 0 in accumulated depreciation, what is the book value of the asset? It's $120,000. Of course, because your accumulated depreciation when you start is nothing, isn't it? There's none, right? It's nothing in year 0, right? That's where we started. Okay, so let's do year 1. Well, here's what we're going to do. What would straight line have been? What portion would you take every year? 20%, right? It's 1/5 per year. 1 year divided by 5, right? It's 20%. It's 1% per year. And I want to double that. It's going to be 40% per year. That's it. What if it was 150% declining balance? I take 20 times 1.5 and I get 30% every year. Got the idea? What if it's 125? Take 20% times 1.25 and I guess that's 25% every year. Got the idea? It always stays the same. What if I had a 10-year life? Do a 10-year life for me. What would it be straight line? 1/10, 10%. Double it. 20%. Got the idea? Okay. Everybody got the idea? You can do any percentage you want, any life you want. Okay? Okay? Lots of people use this. Okay? All right. When we get to tax, talk about the taxes a little bit on this. We always use accelerated methods for tax. By the way, we use a different method for financial statement purposes than we do for the tax return. Years and years ago, you had to use the same one, right? Now you don't do that anymore. It's sort of like the LIFO, FIFO mess, right? There's a problem here too. So what we do for tax return, we use the shortest life we possibly can if we're profitable, right? We want the expense to offset our income and avoid paying taxes. So the government in their infinite wisdom gave us what? Really high depreciation. You read about MACRS, Modified Accelerated Cost Recovery System. It's modified because there used to be one that was just acres, right? Accelerated Cost Recovery System. That lasted 1 or 2 years, and it's been a whole bunch of years of modified. But anyway, it's still called MACRS. Okay? Extremely fast depreciation. Very short lives. This truck is only going to last for 3 years. No, it's not. It's going to last for 5. But we'll depreciate over 3. And then double declining balance on lots of things. Buildings get used up in 10 years. What does this do? It allows you to have a whole bunch of depreciation expense on your tax return, and you pay less taxes. What does that encourage business to do? I said I was going to go later now. I'm doing it. What does that encourage businesses to do? What does UPS do to people like that that can afford new equipment? Every few years, they get rid of the equipment, long before they use it up. Okay, here's the deal. They save taxes, and it creates jobs. Now, depends on where the truck's manufactured, where the job's created, right? But it does create economic activity, it does, okay? So that's the idea, and it really works. You encourage people to get rid of assets before they use them up. Doesn't sound very good for the environment, does it? Well, it's a double-edged sword, right? It does promote the economy. It saves companies tax dollars, right? Of course, the government doesn't have enough taxes, right? Yeah, that's true. But then what happens to that really pretty new truck when UPS gets rid of it? Still in really good shape. It goes to a smaller business and helps that smaller business develop and survive. They can buy really nice trucks, right? Otherwise, if we didn't have this tax incentive, what would UPS probably do? Keep the truck longer until they used it up. And now the smaller businesses would have a heck of a time getting trucks. Got the idea? They'd be driving around in dangerous things, okay? You know what we do, unfortunately, with airplanes after Delta gets done with it and they sell it to some charter outfit that's not as good anymore, right? After one of the major airlines gets rid of it, right? It goes to a charter in the U.S., but then after it's not legal to fly into the U.S. anymore, what do we do with it? We sell it to Latin America or Africa. And they fly around. Oh, I don't know if I like that very well, but better for the environment. Although, you know what? I used to fly on Nika Airlines. My wife is the MBA director here, and she got rid of that. It's so disappointing. But it's really cool. It's kind of dangerous. They had these third-generation planes, right, that had been used by a couple different airlines, and they had them. Nika Airlines going to Nicaragua. You're going down there. It was the coolest thing. They served Nicaraguan food, which is unbelievably good. Unbelievably good stuff. Latin American food is pretty good anyway. But we think all of it is Mexican, don't we? But it's not. Okay, anyway. So Nicaraguan food tastes different than Costa Rican food or whatever. Anyway, so we're eating Nicaraguan food, and then the really cool thing, too, besides that, was and they had all Nicaraguan employees, of course, and they would, you know how you get those little tiny bottles, right, of bourbon or whatever you're drinking on a plane? They didn't bother with that. They had a big metal cart that they rolled up and down the aisle. I'm not kidding. Full of half-gallon bottles of the different types of alcohol. It was a lot of fun. I'm not sure about the safety of that, but, this big metal cart up and down. I guess if you crash, you're happy. I don't know. So, yeah. So my wife found out about all that. She started making us fly on American or something. It was so boring. It was like going to Dallas or something. Yeah. Except when you got off the plane, it wasn't like Dallas at all. Okay, I guess I'm done, aren't I? I'll have to do this one next time. I talk too much. All right, you guys. Remind me where we were. We'll pick up with sort of the same example. Sound good? Come.